This video today might surprise you. In today's video, we're going to talk about how receiving an income raise at work, if you're not careful, can actually move you further away from your retirement goals. Now, this video is primarily meant for those in the accumulation phase, still earning and saving for retirement. But even if you're not in the accumulation phase, you might find value in sharing this video with someone who is. Let's get into it. Now, we're going to use an example throughout this video, and this example is adapted from a book called Just Keep Buying by Nick Majuli. And it's an overly simplistic example, but that doesn't take away from the message within this video. So let me explain. We have two families here with two wildly different savings rates. We have the Smith family and the Johnson family. Now, both couples make $120,000 after tax. The Smith family saves 15% of this after-tax income, which means they're spending about $102,000 per year, whereas the Johnson family saves 50% of their income. Now, if we just use the simple 4% rule in order to estimate how much these couples need to save for retirement, we can simply take their spending right now and multiply it by 25, thus being able to take 4% starting out in retirement. This would leave the Smith family to need about $2.55 million in order to retire, and the Johnson family would need about $1.5 million. How far then are each of these couples away from retirement? Well, if we just take out inflation and we use a real return, we're going to use a real return of 5% per year. If inflation's 2.5%, this would mean their portfolio is really earning about 7.5% on an ongoing basis. And so with saving $18,000 per year and earning 5% as a real return on their money, we see that the Smith family is about 43 years away from retirement. The Johnson family, however, is only 17 years away from retirement. And this really isn't surprising. They're saving quite a bit more and they need quite a bit less for retirement. Now, the question we're going to cover in today's video, however, is what happens if both of these families earn a raise? In theory, this should help both families get closer to their retirement goal that much faster. But as we'll show, that's not exactly the case if they stay with the same savings rate. So let's fast forward in time, and let's say both couples receive a raise after year 10 within this hypothetical illustration, and they're now earning $200,000 after tax. Well, at this point, the Smith family has accumulated about $257,000, and the Johnson family has accumulated $857,000. Now, they receive an $80,000 raise. Their income goes from $120,000 a year to $200,000 a year. And let's say they stay at their same savings rate of 15% for the Smith family and 50% for the Johnson family. This leads to the Smith family spending $170,000 and the Johnson family spending $100,000. And because their spending has increased, the amount that they need for retirement has also increased. And so with spending $170,000, the Smith family's need for retirement has now updated to $4.25 million, and the Johnson's family's need has updated to $2.5 million. Well, interestingly enough, after updating their expected retirement timeline, despite both of these families saving more, they're actually further away from their goals. The Smith family's timeline has updated to being ready to retire in year 47, and the Johnson's family's timeline has updated to year 21. Both couples will now need to work an additional 4 years in order to meet their retirement goal. And this is primarily due to lifestyle creep. The reason here is because they updated their spending. Even though they updated their savings, their updated spending now causes them to need more for retirement. And so then the question arises, how much would they need to save of that raise to stay on the same track they were previously on for retirement? Well, interestingly enough, the Smith family would need to update their savings rate from 15% up to 25% on that additional raise that they receive. This would update their overall savings rate to 19% and would still allow them to retire in year 43. The Johnson family, however, would need to save much more. They would need to update the savings rate on the income raise that they received to 75%, up from 50%. And so now they have an overall savings rate of 60%. And so there's two interesting things we can see from this example. The first is that when you receive a raise, your savings rate needs to rise in order to stay on track. This is because your lifestyle, by definition, has also risen. Thus, the multiple that you will need down the road for that portfolio in order to retire has risen. The other interesting thing is the higher your initial savings rate, the higher your savings rate needs to rise with that raise. For instance, you can see here that the Smith family only needed to raise their savings rate from 15 to 25% for that additional raise. The Johnson family, however, needed to raise their savings rate from 50% up to 75%. Now, there are a few things I want to clarify to make sure I'm sending the right message with this example. The first is that understand as you run these calculations yourself for your situation, understand that lifestyle creep, thus raising your spending, later in life is more costly. The reason being is when you raise your lifestyle earlier in life, you have additional years where you are saving more and thus allowing those savings to compound. Think about it this way. If we received a raise in the very last year before we were going to retire and we raised our lifestyle and then needed our retirement savings goal to adjust, it'd be a lot harder to catch up. We'd push back retirement much further. Also understand that I don't show this example to try to make a case that anytime you receive a raise, you should just save all of that raise. I think your lifestyle should adjust higher. After all, the whole point of money is to be used as a tool. And so if we're receiving income raises throughout our working career and we're not seeing any benefit in our current lifestyle because of that, I think there is some adjustment that should be made to have some lifestyle creep built in. And then finally, number 3, understand that not all lifestyle creep is created equal. For instance, let's say that you have some lifestyle creep, you have a growing spending budget that's related to work. Well, we would assume that once you stop working and are retired, that budget or that cost would then stop. And so that's not something that needs to adjust your retirement goal, how much you need for retirement. Now, although this example was simplistic, that doesn't take away from the message from this example. I know I found it illuminating when I first read Nick's book, and I hope you found it illuminating as well. Now, whether you're currently in the accumulation phase or you're in the distribution phase, learning important financial skills is beneficial throughout all phases of your financial life. But I think the most important financial skill to learn is one of the hardest. I talk about that skill in this video right here. Always remember, you don't need more money, you need a better plan. Thanks for watching.